1.2 trillion, that is how much Americans are carrying right now on credit cards. Not mortgages, not student loans, not car payments, but credit cards. The kind of debt that quietly grows every single day you don't pay it off. And here's what makes this number terrifying. The average credit card APR in the United States isn't 10% and it isn't 15%. It's often in the mid-20s. That means for millions of families, credit card interest isn't just a small extra cost, it's a second rent payment. It's a monthly leak that never stops leaking. So when people saw the headline that Donald Trump is calling for a one-year cap on credit card interest rates at 10%, the reaction was immediate. Finally, relief. Finally, someone is doing something. Finally, the pressure comes down. But what if the most dangerous part of that plan isn't whether it passes or even whether it works? What if the most dangerous part is what happens if it actually becomes real? Because in America, when you squeeze one part of the financial system, the money doesn't disappear. It moves, quietly, strategically. And when it moves, it doesn't ask for permission. It doesn't care about headlines. It doesn't care about fairness. It only cares about survival and profit. Today, I want to show you the uncomfortable truth behind a 10% credit card interest cap. Why it could feel like a win at first, and then turn into a credit shutdown that hits millions of Americans right where it hurts. Not in Washington, not on Wall Street, but in your everyday life. We have to begin with the present day number that explains everything. The United States is sitting on roughly $1.2 trillion in credit card debt. That isn't just a statistic, that's a system. That's people using plastic to cover groceries, gas, rent gaps, and unexpected medical costs. And it's important to understand something very clearly. Most people are not using credit cards because they want luxury. They're using credit cards because the cost of living rose faster than their paycheck. When rent climbs, when food inflates, when insurance premiums jump, and when wages don't keep up, families don't magically become more responsible. They do what they must. They swipe. The swipe feels painless in the moment. That's the trap. The damage happens later, in the interest. Credit card debt is different from almost every other form of debt because it's not structured for mercy. Mortgages are long-term and they have collateral. Auto loans have collateral. Student loans come with programs, regulations, and deferments. Credit cards are revolving, unsecured, and priced like emergency lending. You don't pay interest once a year. You pay it constantly, every day, every month, every year. For millions of households, this has turned credit cards into something darker than financial convenience. It has turned them into a treadmill. You pay and you pay, but the balance barely moves. That's why the idea of a 10% cap feels like a miracle. If your APR falls from 25% to 10%, it sounds like your debt burden just got cut in half overnight. But that's only looking at one side of the equation, the borrower. To understand what really happens next, you have to look at the side that controls the gate, the lenders. Banks don't process political announcements the way voters do. Voters hear lower interest and think relief. Banks hear lower interest and think risk. Banks don't exist to be kind. They exist to price risk and protect capital. And when you cap the price, they can charge for risk. They don't simply accept smaller profits and keep lending like normal. They adjust, they reposition, they restructure the system. This is where the hidden part begins. The part nobody's talking about. Because if a 10% cap becomes real, even temporarily, banks will not just earn less money. They will start quietly moving credit away from risk. That movement begins in the shadows, long before the public sees it. The first change is the simplest and the most silent. Credit limits begin shrinking. If you are a bank and you're forced to lend at 10% instead of 25%, but the risk of non-payment is still the same, you reduce exposure. If someone once had a $10,000 limit, they might suddenly have $4,000. If someone had $5,000, they might suddenly have $2,000. Not because they did anything wrong, not because they missed a payment, but because the bank is updating its survival math. And when your limit shrinks, something else happens. Your utilization rate jumps, your credit score can fall, and once the score falls, you become more expensive and more risky to lend to, which increases the likelihood that limits shrink again. That's how people spiral downward in the credit system. It's not always about bad behavior. Sometimes it's simply about the gate moving. The second change is where the pain becomes widespread. Approvals tighten. This is the part most Americans don't anticipate. The credit card system isn't designed to offer equal access. It's designed to balance profit and risk. When profit gets capped, risk gets punished harder. That means approvals tighten fastest for young borrowers, for people with thinner credit histories, for lower income households, for gig workers, for anyone whose financial profile isn't stable enough for lenders to trust. These are the exact people who are most likely to rely on revolving credit just to get through the month. In other words, if a cap becomes real, the most likely consequence is not that everyone pays less interest. The most likely consequence is that millions of people lose access to credit. That's not a theory. That's how lending works. If lenders can't charge more for risk, they stop taking risk. And when they stop taking risk, The yes turns into no. Not loudly, not politically. Quietly, through algorithms and underwriting adjustments that most people never notice until they're denied. The third shift is where this story becomes even more uncomfortable. Banks begin replacing interest profits with fees. In finance, money doesn't vanish when you squeeze it, it simply finds a different pipeline. So instead of earning through APR, lenders begin earning through annual fees, balance transfer fees, late payment fees, membership tiers, higher penalties, and reduced generosity and benefits. The cost of borrowing doesn't always go down. It simply gets repackaged into something that looks less obvious. This is why the real question isn't just whether a cap reduces APR. The real question is what happens to the structure of consumer credit once lenders cannot price it the way they want to. And this is not the first time in history that interest control has created consequences. In fact, it's one of the oldest patterns in economic history. Every time power tries to control the price of borrowing, the market adapts. Kings, governments, and lawmakers have attempted interest caps for centuries because debt has always been politically explosive. The logic is always the same: protect the people, reduce the pain, stop predatory lending. But the result, again and again, is predictable. When interest is capped, credit becomes scarce. In medieval Europe, rulers regularly tried to limit lending rates because debt was crushing communities. But lenders didn't simply comply and lose money. They stopped lending to risky borrowers and focused on the wealthy. They demanded collateral. They created hidden costs. They pushed lending into informal channels. And the people the caps were meant to protect ended up with fewer choices and harsher alternatives. Fast forward to modern economies, and you see the same pattern in new clothing. Cap prices and supply dries up. Control the profit, and the industry finds another way to earn. Restrict lending economics, and access becomes tighter. Even within the United States, interest rate rules have shaped where banks operate and how they lend. Financial institutions historically migrated toward environments that offered better margins and fewer restrictions. That's not politics. That's gravity. Capital goes where it can breathe. So a credit card cap may sound like a clean solution. But history tells us something blunt. You cannot legislate risk out of existence. You can only decide where that risk gets placed. Usually, it gets placed on the people with the least power. That brings us to what happens next, because if this policy ever becomes more than just talk, the timeline is almost scripted. First comes the announcement phase. Banks don't wait for laws to pass. They don't wait for signatures. The moment policymakers begin pushing something like this seriously, lenders begin modeling the future. They run scenarios. They ask, if APR is capped at 10%, how do we protect profitability and reduce defaults? That discussion does not happen on TV. It happens behind closed doors with spreadsheets and risk committees. Then comes the quiet tightening. Limits begin changing. Approvals become stricter, and credit score thresholds rise. This is why, in many financial shifts, consumers feel like something changed out of nowhere. 1 month, your offers are everywhere. The next month, you're denied. That isn't random. That's the gate moving. After that comes the fee era. This is where the visible consumer experience shifts. Cards that were once free begin carrying annual fees. The cheap cards begin introducing new charges. Penalties become less forgiving. And slowly, the system begins shaping credit into a membership experience, where better terms are reserved for the safest borrowers. Then comes the reward cut. This part matters more than people realize. Cashback, travel points, huge sign-up bonuses, these aren't gifts. They are funded by the economics of the system. They are financed, in part, by the profits lenders make from revolving balances, fees, and interchange revenue. If one profit stream gets squeezed, the luxury perks are often the first thing to go. That's why an APR cap could easily trigger a rewards apocalypse, where perks shrink, bonuses shrink, and the golden era of free points begins to fade. But the biggest shift comes after all of that. The system becomes prime only. That is the long-term risk. Even if the cap is temporary, the structural change might not be. Once lenders tighten credit, many don't casually reopen the gates. The memory of risk sticks. The models remain conservative. And consumer credit starts behaving like a club. If you have stability, you're in. If you don't, you're out. And once people are out, they don't stop needing money. They simply migrate to worse alternatives. That is the cruel paradox of this story. A cap meant to reduce financial pain could unintentionally push millions of Americans toward more predatory lending systems, where the cost of borrowing isn't lower, it's higher, just hidden under different names. Now we arrive at the most important section, the personal stakes, because this affects you differently depending on where you are. If you have excellent credit, stable income, and strong savings, you might benefit. You will still get approvals. You will still have high limits. You may even get better terms as banks compete for low-risk customers, but even you will feel it. Rewards could decline, fees could rise, and financial institutions could become more aggressive about segmenting customers into tiers. If you're in Middle America, the squeeze zone, you are in the most dangerous position. You're not wealthy enough to be protected and not poor enough to qualify for assistance. You use credit occasionally and sometimes carry balances. If the gate tightens, you are at risk of limit reductions, score drops from utilization changes, surprise denials, and rising costs through fees. And these things can stack. One limit cut can turn into a score drop. A score drop can turn into a higher cost or fewer approvals. And suddenly, someone who was doing fine finds themselves slipping. If you are already relying on credit to survive, this is where the story becomes brutally real. For millions of Americans, credit cards are not optional. They are a lifeline. They bridge the gap between paychecks, they cover emergency expenses, they keep groceries in the house. In that world, a cap could sound like help, but it might not mean cheaper interest. It might mean no credit. It might mean a closed account, a limit slashed in half, a denial when you need it most. And when credit shuts down, people do not stop needing money. They turn to buy now, pay later services, payday loans, cash advance apps, installment lenders, and prepaid products loaded with fees. Many of those options can cost far more than the credit cards they replace. That's the darkest twist. Sometimes the thing designed to protect people ends up narrowing their options, and the narrowest options are often the most expensive. So the message here isn't political, it's structural. The credit system is not designed to be fair. It's designed to price risk. And if you cap the price of risk, you don't eliminate risk. You eliminate access. And the people who lose access first are often the ones who needed relief the most. If there's one practical takeaway from this entire story, it's this: treat your credit like a gate that can close. If you carry revolving balances, do not assume the system will remain generous. In times of policy uncertainty, banks tighten. In times of margin pressure, lenders become selective. That's how the machine protects itself. This doesn't mean panic, it means preparation. Because even a small cash buffer gives you power. Lower credit utilization gives you stability. Reducing balances, even slowly, reduces the interest tax you pay every month. And if the system tightens, the difference between being approved and denied is often not massive. It can come down to a few points, a few ratios, a few months of stability. So yes, a 10% credit card cap sounds like good news. And for some people, it might be. But the real story is what happens behind the scenes. Banks don't lose money quietly. They move capital. They change the rules. They tighten access. They repackage costs. And the consequences don't appear in headlines. They show up in your credit limit notification, your denied application, your shrinking rewards, your unexpected fees, your rising cost of survival. The next time you see a headline promising cheaper credit, remember, finance always has a second headline, the one they don't print and the one you end up paying for.